All right, hello, and welcome to Camel Finance. I'm your boy Camel, and today we've got some Bitcoin stuff, which is nice and positive. Okay, we got a little bit of equity talk, and then I'm afraid I have to take you to some dark places. I wasn't really intending on doing this, but it's going to get a little dark. It's going to be a little bit of speculation, and we're going to talk about the US Treasury Department possibly having to default on its debt in June. So I'm going to preface this by saying I don't actually think they're going to default just yet. But we'll get into that. For now, hit that like button, sit back, relax, and let's get into this. Watching people super bearish until Friday now act as if they were all over this move and put out higher price targets is funny. And indeed it is. You really have to be careful who you follow and trust in this space. The majority of the market has been expecting 10, 12, 14k Bitcoin to show up. And of course, as a market, anything can and will happen. However, it's important to keep in mind that markets move to hurt the most amount of participants. And when everybody is expecting one final dip, then the path of most pain is, unfortunately for them, higher. This is exactly what we're experiencing right now from the Bitcoin price, as we are currently sat above 21,000 US dollars. Over in Nigeria, a study has found that Nigerians are the most optimistic citizens in the world about the future of Bitcoin. And this is likely because, as I say over and over again on this channel, they've had a CBDC for over a year. That CBDC has less than 0.5% adoption versus Bitcoin, which is currently being used by over 35% of the adult population. Nigeria is the best example on this planet of how Bitcoin can be used to separate money and state, and how Bitcoin can be used as both freedom and hope and a resistance to the CBDC tyranny that the central banks want to enforce on everybody. Lightning continues to grow. The Lightning Network, the layer 2 solution that allows for instant and nearly free transactions to take place on top of the core Bitcoin protocol. In the past 24 hours, they've added 20 nodes, 430 channels, and 22 Bitcoin. The total capacity now sits at just over $108 million. In other news, Crypto.com has signed an 8-year agreement to neutralize their direct carbon emissions, so this is a trend I expect to continue. The Bitcoin price has broken above the short-term holder cost basis. Again, anything can happen, it's a market. But for now, if we look left, what we'll see is every time this happened, with the exception of this occurrence here, Bitcoin, once it broke out above the short-term holder cost basis, went on an enormous upside rally. We also have the power law model. In blue is where you should DCA into Bitcoin, dollar cost average. And in pink is where you should DCA out or ladder out. Bitcoin is currently making an attempt to break out of the DCA range of $13,000 to $22,000. If Bitcoin's price can do that, we should be targeting a move to the top of the band, which currently sits between $101,000 and $157,000 per Bitcoin. Peter Brand, a classical chartist and technical trader since 1975, he says any idiot can make wild guesses about the markets, so here is his dunce hat prediction. In reality, nobody has a clue what any given market will do. What I found really interesting about this is not dissimilar from my prediction. I think we're going to make a top slightly above these prior highs this year, and then we're going to spend the following 3 years in a bear market decline. So have we got a little bit of confluence or perhaps even confirmation bias here? If we go to a quarterly chart where every one of these candles represents 3 months, Bitcoin is within a few $100s of triggering a quarterly buy signal. This long-term strategy historically outperforms just buying and holding. You buy when the high of the previous quarter is broken, and you sell when the low of the previous quarter is broken. So you can see here, once the quarterly candle breaks the prior one, you sell. And once the quarterly candle breaks above the prior quarterly candle, you buy. And you can repeat this. And historically, this has been an incredibly simple yet effective strategy. A Bitcoin price of around $22,000 will trigger this buy signal. Things continue to look very, very bullish for 2023. Over in the equity world, we've got the internet's favorite fractal. This is the S&P overlaid with the 2008 fractal. If you are a bear, if you want to see lower lows, if you want to see this fractal complete, it really needs to roll over soon. This seems to be deviating and seems to be deviating significantly. As a structural technical trader, I would say I cannot have confidence that this is not going to roll over until this prior high, this local high here, is taken out. But take this high out and I would say we can absolutely, with 100% certainty, scratch off this 2008 fractal. Again, if you're a bear, you want to see this roll over, and you want to see this roll over ASAP. So from the good and the bad to the downright ugly, now it's time to get into the US and the possible default on its debt. The US is going to hit its debt limit on Thursday. This is just 2 days away from the time of recording. And it's going to have to start taking steps to avoid default, according to Janet Yellen. Experience in the market has told me the likely path forward for here is for them to either remove, i.e. suspend the debt limit ceiling, or for them to increase it. The US Treasury Department has been warning that the country could actually end up defaulting on its debt as soon as June. So rather than me try to explain this, I found a little clip. I'm going to play you this clip, and then I'm going to give you my 2 cents on how this whole thing might end up shaping up.
Treasury Secretary Janet Yellen is warning the U.S. is expected to hit its debt limit on Thursday. The national debt stands at more than $31 trillion. The country's total borrowing limit is $31.4 trillion. Secretary Yellen told Congress on Friday that once the limit is reached, the Treasury will start taking, quote, extraordinary measures to prevent a default. So CBS News congressional correspondent Scott McFarland is joining us now from Washington to tell us exactly what this means. Can you explain what hitting the debt ceiling means and what the consequences might be?
Hey, Marie, good morning. First of all, this is going to be likely the defining issue of the next year in Congress. This one transcends everything else because the debt ceiling for the federal government is like your credit card limit. Once you hit it, you can't borrow anymore, which means you can't pay down the debts you've incurred. The government would not be able to pay for things like Social Security, Medicare, veterans benefits, air traffic controllers, food safety inspectors. This is not a realistic proposition, so something needs to be done to raise the debt ceiling after Thursday. Now, the Treasury Secretary says she can move some things around, some extraordinary measures to buy the federal government some time, but only some time. A matter of weeks, potentially a few months until this crisis hits again and there's no more flexibility. Republicans and Democrats have divided control of Congress and they have divided views over what to do about this. So a potential cataclysmic face-off seems imminent now.
So tell us about the, quote, extraordinary measures Secretary Yellen plans to take to prevent a potential default.
Yeah, she will not stop paying for veterans benefits, Social Security, air traffic controllers. What she can do, and the Department of Treasury can do, is stop paying for things that don't have an immediate benefit or need, like stop making some payments towards pensions and retirement benefits for federal workers that aren't going to be tapped into in the next few months anyhow. They'd make those payments whole after the crisis subsides. You can stop paying into thrift savings programs. Those are basically the federal government versions of 401ks. Because again, the federal workers won't be tapping into those immediately. You can wait and make those payments whole later. But there's only a limited amount of bandwidth there. You can only buy yourself a matter of weeks because the federal government spends trillions of dollars on things they can't pause spending on. That's why this is such a high stakes game of chicken. And at this moment, this looks exactly like the standoff did 11 or 12 years ago when this was last an issue, where neither side seems willing to bend.
All right, so could there be common ground with President Biden, and what else can lawmakers on Capitol Hill do to prevent the debt hitting the debt ceiling?
There's no indication that there's a meeting of minds here as we approach this deadline. There's almost a philosophical difference more than a practical one. Republicans believe, especially in the U.S. House, that they need to exact some cuts in spending to reduce the deficit, reduce the need to have to borrow as part of any deal to raise the debt ceiling. The White House has said there's no negotiating over this. This is too radioactive. It's too toxic to even play with negotiating on this issue. If we're going to make cuts, we can do that through the traditional government spending bills that the Republicans have to approve before they become law. We don't negotiate on the debt ceiling. So as long as that philosophical dispute is there, this is a particularly dangerous thing because in 2011, when these similar political dynamics existed, as a similar standoff occurred, it hit the U.S. credit rating, it damaged the stock market, it hit the economy in a real way, and it wasn't even breached. It was just approached. And we seem to be on a glide path toward approaching a debt limit standoff right now.
So there you have it. We've got a number of things to talk about. I think, first of all, I would like to point out that the most probable outcome in the short term is that they will either get rid of this debt ceiling. They'll either just remove it entirely, or they will increase it, which will buy them enough time to continue to kick the can down the road, to continue to take on more debt at an unsustainable rate. Looking out a little bit further, the question becomes, will they actually end up defaulting on their debt? And could it actually occur in June? Before I talk about whether or not I think that's feasible, I want to point at a few things. There's a few canaries in the coal mine here, a few red flags flying high for everybody to see. One of those red flags is China. China has added another 30 tons of gold. Do you think it's because China sees the writing on the wall? And it's not just China. We're also seeing worldwide central banks' quarterly gold purchases in tons absolutely skyrocketing. This is likely behind the recent pump in the gold price, and it also explains why silver has been lagging a bit, which is usually a higher beta move. Usually when gold gets going, silver gets going even further, but that's not what we've seen under these current conditions. And the reason for that is likely because the gold buying is driven by central banks at this moment in time. Over in Iran and Russia, they want to team up and issue a new stablecoin backed by gold, again, Do you think it's because they see the demise of the dollar? They see the writing on the wall? That's personally what I think. So let's talk about this default. The truth is, default is not really an option. Okay, the debt has been monetized. This is what bonds are. If the US was to default on this debt, to not pay it back, then overseas investors, countries, will essentially be stolen from, and this could cause war. So to explain this a little further, when the US government or any government wants to raise money, the first thing it does is it creates these bonds. It monetizes the debt by issuing bonds. Then it sells those bonds to either overseas investors or countries. Remember, every country all around the world holds US treasury bills, holds US bonds, holds US government debt. This is how the US government raises money. And of course, overseas investors are happy to do this for two reasons. One, they get compensated by earning interest on the bond. So the US says to them, hey, buy our bonds and we'll give you 3 or 4% a year interest. And two, these countries, these nations hold US government debt. They hold US bonds because the US has the world reserve status. The dollar is the current world reserve currency. This means these overseas investors in these countries, these nations that are holding the US government debt see this investment as the safest form of investment. So for the US to just default and say, sorry, not only are we not going to pay you the interest on the bonds anymore, but we're not even going to give you the money back. You're not even going to be able to reconvert your bonds into cash. Is similar to saying the countries have just been stolen from. This could absolutely cause war. How do you think these nations, these countries will react if the government just says, remember that bond that you bought from us and we promised to pay you a yield on? Yeah, well, now you're not getting any of it back. It's not just countries and nations that will be stolen from. Remember, pensions have a 60-40 portfolio, where 40% of every portfolio, as standard, is allocated to bonds. Hedge funds will also be stolen from. Insurance companies. Remember, insurance companies don't keep your money in a bank ready to pay out for when you crash your car or burn your house down. They have a portfolio that tries to outpace inflation, much of which is held in seemingly safe treasury bills and bonds. Said another way, US government monetized debt. Remember, it's also corporate treasuries, and the list goes on. All of these will be stolen from. Sorry, we can't honor our promise. Not only that, you're not getting your money back either. So with all that said, I hope you can see, default is not really an option. The only option here is printing. Printing money to inflate the dollar makes the debt more serviceable. The number stays the same, but the value, the purchasing power, is worth less. This is the primary reason for inflation. It enables governments to service their debt easier. So I think all paths lead to printing. Unless, of course, what if we're going to go full reset? What if they never had any intention of paying this debt back and instead their intention all along was to default? Could this be masked under the guise of a cyber attack? I'll play you a quick 30-second clip here.
Attention to the frightening scenario of a comprehensive cyber attack, which would bring to a complete halt to the power supply, transportation, hospital services, our society as a whole. The COVID-19 crisis would be seen in this respect as a small disturbance in comparison to a major cyber attack.
So instead of have to own their mistake, instead of have to default on the debt, do they blame some sort of cyber attack? Do they blame some other nation so they don't have to hold their hands up and tell everyone that they were stolen from? It is worth noting, I think, that no matter whether we go full reset or whether we first have to see the dollar debased to near zero, in either scenario, I think all paths likely lead to printing the dollar and all other fiat currencies to death. This is why it's so important to exit the system: Bitcoin, gold, and silver. Only physical in your hand, only Bitcoin on a cold wallet. Nobody knows what's going to happen, but the writing is on the wall and the central banks seem to know something. The last point I want to make is that the Bank of America says the Fed peaks at 4.9% by June and then cuts to 3% by December. Here's a thought exercise. If there's no recession and unemployment remains strong and stocks are rallying and inflation is cooling, why would the Fed need to cut rates? Well, here's a reason. Because they cannot afford to pay the interest on these bonds. They cannot afford to keep rolling over the debt and keep accumulating more debt. They've already run out of space. Where's the graph? Here it is. They've already run out. They've already hit the ceiling. It doesn't mean they couldn't raise the ceiling. Like I've said earlier in the video, I think the most likely path is that they will raise the ceiling or suspend this entirely. But one reason that you could see them move to a pause soon is that the higher these rates go, the more interest they are obligated to pay. Interest that they cannot afford, and therefore the more debt that they accumulate. So as we look forward to the Fed meeting in just a couple of weeks, the expectation is that we will have a 25 basis point hike, and perhaps that will defeat inflation. Expectations for a 25 basis point hike currently sit at just under 92% probability. So the question for me is, do we get a pause in rate hikes following this, like the 2-year yield and the bond market has been calling for? Is a bull trap coming out of the dollar? Here's the dollar. Are we going to finally get a reaction off of this blue upward sloping support line like I had long suspected we might? Seems that we're thinking about it, although it does not preclude a move to the downside. I would think naturally here, especially given where the cycles in gold are, which I'll show you in just a minute, I would think naturally here some kind of bull trap that then resolves down is what's most likely. But of course, I have no idea what's going to happen. I can only react as the market tells me. Here you go. You can see that here as well. This is gold. Gold looks to be putting in a swing high, looks to be wanting to drop down into a cycle low. Can we get a cycle low that then makes a final attack up to the top of this range here? That's my expectation. Of course, anything can happen. Silver refusing to break out. I was looking for a long trade here or a break above this box, but it just hasn't given me the signal, okay? It just hasn't given me the signal. Given where the dollar is looking to rally, given where gold is looking to pull back, maybe we're going to get a nice entry from silver where we get this bleed down and we can draw a trend line and then buy the break out of that. So I'm happy to sit on the side, stay neutral silver. I still have my precious metal exposure. I still am long miners and junior miners, although I expect with gold's pullback, these are likely to possibly come down and backtest the top of this box before moving higher one last time. The US government 10-year bond yield looks to be bouncing off some form of double bottom. Is it going to get a counter trend move that then resolves down? I want to see these lows taken out for risk to come on. If that can't happen, then the stock market and precious metals are going to be under some pressure. Here's the 2-year yield. We've lost this big level here, currently working on a back test. It could really go either way at this moment, but the bond market continues to say that it does not believe the Fed is going to continue to hike aggressively, likely because of the whole issue with the debt ceiling. Bitcoin doesn't care. Look at Bitcoin go. Continues to push up. If I flip into log scale, you can see we're really thinking about breaking out of the last line of repair for Bitcoin. So can it do it? I don't know. For now though, long and strong, continue to push. Ethereum continues to look constructive. So I like what I see here. Natural resistance at this cluster of highs. I expect this to resolve to the upside. XRP still can't get above 40 cents, but that's fine with me for now. Still playing patient. MATIC continuing to push up. Seems to want to be a leader. So if it wants to lead, let it lead. Zcash. Again, not much more to say. Long and strong, continue to push. We'll see what happens here going forward. Still playing patient with Tesla. We'll see what happens. Can this break out? Preferably breakout, retest, resumption. And this could be a long from me. But for now, not super interested. Apple has got a bit of work to do before we can think about entertaining longs. But for now, not really interested in Apple either. Be interesting to see what comes out of Marathon and Riot and Coinbase and MicroStrategy today, given that Bitcoin has had a nice move to the upside over the past couple of days. Here's Riot, as you can see. So not much to say about long, apart from long and strong, continue to push. Same is true of MicroStrategy. Kind of expect to see this resolve to the upside, and Coinbase as well. I expect to be getting back above $60 in the near future. So we'll see about that. The FTSE 100, not really much to say about this, apart from long and strong continue to push. I want to see this continue to press up towards 8,500 or a touch of this upward sloping red resistance line, and that is where I'll look to take the profit on this trade. So if we can get some kind of base that then resolves higher, I can move the stop to break even and be happy to have zero risk exposure on this particular trade. VIX is up a little bit back to the 20s, but not really speaking to a volatility event at the moment. I think I'm going to move this line to here. A breakout of this red line, and this might have to be a hedge put back on. So it would look something like this, just in case we end up seeing a stock market plunge coming off the back of this issue with the debt ceiling. Bears, if you're a bear in the Dow, you want to see this roll over and you want to see it do it quickly, because get above this red line here, and I think it's game time. I think this confirms that we have absolutely 100% left behind the bear market lows back here, and we'll be looking to attack new all-time highs. Believe it or not, given all the bearishness out there, all the bearish narratives, we're actually only about 7.7% from the all-time highs in the Dow. This to me does not speak to bear market rally, but of course I'm open to changing my mind if the market tells me to do so. The Nasdaq trying to make a run at this resistance. If it can break out of here, then that will be a long from me, as I've been saying over and over again. Lining this up, remaining patient, no need to rush in here. And the S&P, it would be perfectly natural to get some kind of pushback off of this rather than just hot knife straight through it. But the thing is, if you're a bear, again, you really need to see it come down and take out these lows here. Failure to do that, anything that kind of looks a bit like this ends up coming down here and then breaking out. You have to flip long if you're a bear, just like I have to flip short. I mean, I have no position at the moment, to be clear. I'm still lining this up, still waiting for a breakout of this blue trend line, as I've been saying over and over again. But my bias, my expectation is that we are going to break out and move to the upside. So I will have to flip from having a bias and an expectation of bullishness to one of bearishness if the market tells me that. But for now, it's too early to tell. And as ever, one day at a time. If you found value here today, I'd appreciate it if you could drop a like on the video, subscribe if you're not already, and turn the notifications on if you want to continue to get updates on all of my positions, win, lose, early exit, or trade ideas called out ahead of time for free. It's going to be an interesting week. It's going to be an interesting month, and it's going to be an interesting year. I don't know about you, but I'm really enjoying it so far. I hope you are too. In the meantime, take care from me. All the best. Cheers. Bye.